Welcome to Simple Investing Secrets. In today's video, we'll look at 7 deeply undervalued bargain stocks to buy in 2023. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. This year has gotten off to a strong start for all 3 of the major indexes. After a rough year in 2022, which included a short trip into bear markets, the indexes went up in January 2023. Even though this indicates that a large number of leading stocks saw gains, this does not imply that stock prices have increased. Even among stocks that are now experiencing growth, there are still many opportunities to find deals. It is therefore not too late for you to go shopping for a good deal. You should add to your list both stocks that move slowly but consistently and stocks whose prices go up quickly. We've found 7 stocks that are way undervalued, have great long-term prospects, are currently trading at a discount, and may have the potential to make huge profits over time. With that being said, let's review our list of 7 deeply undervalued bargain stocks to buy in 2023. Number 7. Moderna, ticker, mRNA. Investors shied away from Moderna this year, despite the company's billion-dollar earnings. That's because the coronavirus vaccine is Moderna's only product, and investors worried about revenue in a post-pandemic world. But Moderna assuaged some concerns recently when it offered clues about the post-pandemic vaccine market. The biotech predicts it will follow that of the flu vaccine market. If that happens, the global coronavirus vaccine market could represent $12 billion to $24 billion annually. Moderna's vaccine revenue surely will decline from today's annual levels of around $18 billion. But if the company's market predictions are right, it still could continue to bring in significant revenue. At the same time, Moderna aims to launch 2 more respiratory virus vaccines in the coming 2 to 3 years. So the company's growth story is far from over. Moderna stock already has started to rebound over the past few months. But the shares still look like a buy, considering the company's fantastic growth prospects. Number 6. Disney, ticker, DIS. Disney's enormous investment in its streaming services have hurt earnings, and the company is struggling with higher costs. But this entertainment giant may be moving toward more magical days. Longtime Chief Executive Officer Bob Iger is back in the driver's seat. He plans to stay for 2 years to boost growth at Disney and choose a successor who can keep things going. There's reason to be optimistic about Iger's involvement at this point in Disney's story, and that's due to his solid track record at the company. Iger led Disney through successful acquisitions and grew revenue, profit, and share performance during his tenure. Today, fans still love Disney. Revenue at the parks, experiences, and products unit rose 73% in the recently ended fiscal year. That business historically has contributed most to revenue. So this is a key positive from the earnings report. Disney shares trade at 22 times forward earnings estimates, down from 40 earlier this year. Considering the gains we've seen in parks revenue and potential growth with Iger at the helm, this stock looks like a steal. Number 5. Amazon, ticker, AMZN. Amazon gave investors reason to be optimistic after rising by more than 20% the previous month. But the company's earnings report from this week showed that the company is still having financial difficulties. The online retailer Amazon has posted its first annual loss in nearly 10 years. However, this shouldn't come as much of a shock to anyone. Over the course of the past year, higher inflation has hurt each of Amazon's fiscal quarters. Amazon has also struggled with problems that are related to the state of the economy, such as supply chain problems. Also, the company's earnings have been hurt by the investment it made in Rivian, an electric vehicle company that is having trouble. All of these things are problems right now, but they won't change Amazon's long-term prospects. 2 industries that are growing quickly are e-commerce and cloud computing. This company is the market leader in both of them. Even though the economy is bad right now, this position makes it easier for Amazon to keep growing its income. And reducing the strains on the economy should actually stimulate growth. Amazon's current efforts to reduce costs and improve the company's overall cost structure are expected to help lift earnings in the long run. The price at which the shares are traded today is close to where they were in 2016 when compared to sales. If an investor wants to buy a security and keep it for a long time, this is a great place to start. Number 4. Tesla, ticker, TSLA. Shares of Tesla rocketed higher by more than 50% during the month of January. However, additional profits are likely to be on the horizon for this electric vehicle giant over time. Tesla just announced that it had its highest quarterly revenue, operating income, and net income ever. Using generally accepted accounting principles, GAAP, the company's net income for the whole year went up by more than 100%, to $12.6 billion. This is true even though things aren't going well, like the cost of raw materials going up and currency exchanges having a bad effect. And Tesla is just getting started. The previous year saw the opening of not one but two enormous new factories, one in Austin, Texas, and the other in Berlin, Germany. The goal is to achieve an annual increase in vehicle deliveries of 50% on average. In 2022, Tesla increased the number of vehicles it delivered by more than 40%, reaching a total of more than 1.3 million. This brings the company significantly closer to its objective. During the previous year, investors chose to stay away from Tesla because they prioritized safety over growth. They were also concerned about Tesla's percentage of the market. There is a chance that Tesla will lose some market share as competitors add more electric vehicles to their lineups. However, Tesla has a strong brand that will keep it in first place no matter what happens with the competition. At the moment, the cost of all of this expansion is not unreasonable at all. The current price of Tesla stock is 47 times the company's estimated future earnings, down from more than 80 a year ago. Number 3. Starbucks, ticker, SBUX. Starbucks disappointed investors by reporting earnings that fell short of their expectations. However, it is necessary to investigate the following reasons why this occurred. Because there were more cases of coronavirus in China, which is Starbucks' second biggest market, sales were hurt. It may be challenging right now, but this is only a temporary obstacle. And Starbucks has the resilience to prevail despite the challenges. The rest of the report was positive and gave more evidence that Starbucks stock is a good long-term investment. Even with challenges in China, the world's largest coffee chain still managed to report record revenue for the first quarter of the fiscal year. The sum of all revenues increased by 8% to reach $8.7 billion. And the number of people who are members of Starbucks loyalty program, which is known for driving sales, continues to rise. In point of fact, the number of members of Active Rewards has reached 30.4 million, representing a growth of 15% year over year. The data from Starbucks holiday gift cards further bolsters the company's brand strength. This holiday season, consumers in the United States loaded up and spent a record $3.3 billion on gift cards. Starbucks has reaffirmed its outlook for the remainder of the year. In addition, it is essential to keep in mind that the organization is making progress with its plan to reinvent itself over the next 3 years with the objective of achieving growth in both revenue and non-GAAP earnings per share in the double digits. The current price of Starbucks shares is 30 times the company's estimated future earnings, which is down from approximately 40 a year ago. As Starbucks moves closer to achieving its growth objectives, the stock has a good chance of climbing back to those levels. Number 4. Home Depot, ticker, HD. Following a lackluster performance in 2022, shares of Home Depot have begun to rebound. When I say lackluster, however, we're only referring to the performance of stocks. Even though the economy as a whole is struggling, earnings have remained in a healthy range. The group of people who do their own home improvements and professionals have continued to make up the majority of customers at the largest home improvement retailer in the world. In the most recent fiscal year, Home Depot made more money from these two types of customers than from any other. Importantly, the company's professional customers say that their project backlogs are in good shape. This means that they are likely to keep buying materials from Home Depot to finish these projects in the coming quarters. Home Depot also said that same-store sales in Mexico and Canada, as well as all 19 of its regions in the United States, all went up in their own local currencies. Even though the economy is bad, it is clear that people still want to work on projects that make their homes better. Still, investors stayed away from many stocks related to spending money on things you don't have to last year. Because of this, Home Depot experienced a loss of more than 20%. Because of this, the stock is currently trading at a very low price, which is good news because it means we can buy it at a discount. The current price of Home Depot shares is just under 20 times the company's estimated forward earnings, which is a very reasonable price for a company that has maintained consistent growth both in good times and in bad. Number 1. Costco, ticker, COST. Another retailer that has grown despite the slowing economy is Costco, a warehouse club. Month after month, the massive distribution center has reported increases in net sales. The month of January saw an increase in revenue of nearly 7%, which was greater than $16 billion. What do you believe is the secret to Costco's success? First of all, the business model, which demands customers to pay an annual membership fee before they can enter the store, maximizes the company's ability to make money. And this is revenue that has a high margin for Costco. In fact, it makes it possible for Costco to offer the products stored in its warehouses at rock-bottom prices. And that is the second element necessary for the business to succeed. Customers keep coming back because of the low prices. In fact, They find the prices to be so alluring that they don't mind paying the membership fee at all. Costco has global membership renewal rates that are higher than 90%, which shows that the company can depend on these customers to bring in money year after year. All of this indicates that Costco is the type of company that is able to report earnings growth regardless of the state of the economy. Some people believe that Costco trades at a premium given that forward earnings estimates are multiplied by 36. However, when one takes into account its customer loyalty, growth to date, and business model, one can see that its current valuation is actually quite reasonable and has the potential to increase over time. This concludes our list of the 2023 deeply undervalued stocks to buy now. Before putting your hard-earned money into buying stocks or investing in the market, you should always do your research. Don't forget to give this video a thumbs up and subscribe to our channel so that you don't miss any of our weekly updates on the top stocks to purchase and the most innovative investment strategies for accumulating wealth. We appreciate you watching, and we wish you the very best of luck with all of your financial endeavors.